My name is Benjamin Z. Meller, and today I'm going to answer the question, is an investment portfolio that includes bonds really safer, or does it just feel safer? So this is an investor that is familiar or has heard of the classic advice that some of your portfolio should be in stocks and some in bonds. And now they've got the question, is an investment portfolio that includes bonds really safer, or does it just feel safer? Okay, good question. The answer is yes. Yes. Bonds are critical to any well-designed portfolio. I look at a lot of portfolios of my friends and other people that ask me to look at their portfolio. And one of the things that I notice is a lot of times they do not have enough bonds. The percentage in bonds is too low. So yes, bonds are critical to any well-designed portfolio. Additionally, as an investor gets older, the classic recommendations are that they should increase the percentage of bonds they hold in their portfolio. Bonds provide passive income. Stocks, unless they are dividend-paying stocks, I'm not necessarily talking about a dividend aristocrat. If they are dividend-paying stocks, they do not provide any income. By splitting your portfolio with approximately 50% in stocks and 50% in bonds and other income-producing assets like multifamily real estate, you get income and you also get growth. As an investor gets older, they should be increasing the percentage of bonds and real estate they hold in their portfolio and gradually reducing the percentage of stocks. Younger investors that have a longer time horizon can partake in riskier opportunities like private equity type deals that might have a 20x or 40x return in a few years, but also might result in a total and complete loss of all capital. Startup companies can generate tremendous returns on capital, sometimes even as much as 100x, but they are riskier than blue chip stocks. The mistake I see is an over-concentration in blue chip stocks, no bonds, and no shares in startup companies. You need to control risk, but not cheat yourself out of good opportunities. The reason that old ideas on investing are good is that they originally came about for a reason. In the past, when someone put all their money in stocks and then the stock market dropped in value, they often regretted not buying bonds, because if they had, they could, for one thing, if they had bonds, they could sell the bonds after the drop and buy the stocks at the cheaper prices now available. They could trim their bond holdings and take advantage of the drop in the stock prices. The main issue today is that the rates of inflation are higher. So government bonds are not good. Nor are corporate income bonds of big publicly traded companies in terms of real rate of return. However, if you look at privately held corporate income bonds of a company such as Alamo Mortgage Holdings, my company, Alamo Mortgage Holdings, this can earn hundreds of basis points higher and help to offset the inflation in a meaningful way. I hope that helps, and good luck with your investing.